Talk, 1100 KFNX. You're listening to the Business Roundtable. I am Matt Battaglia. We're talking COVID-19, the economy, and mainly how tech is thriving under the current conditions of the economy. So I'm joined by two people who know this industry and know investing very well. I'm joined by Denver Noetz with wealthforlife.net and Robert Reaburn, the Executive VP and Head of Wealth Management with LifePro. So I'm going to start with you, Denver. The tech companies are thriving, and if you're picking stock by stock, you're picking the actual company, you're doing well. But if you're picking the whole ETF, you're doing okay, but there's a problem lurking.
Yeah, there's a big problem lurking, and I think that's part of what people are starting to notice when, I talk to clients about they're looking at their portfolios and going, I'm kind of down with the market, and they're talking to us, myself and Robert, and going, hey, how are you guys doing? And, here we are at the end of July, I think close to 50% is what we're up, obviously dramatically higher. Part of that happens when you look at an ETF that just buys the S&P 500 index, and, maybe half the companies of those 500 are kind of mediocre. The economy goes up 2%, they go up 2%. The economy goes down, they go down. Then you have maybe another 25% of those companies that are really on the downslide. They're not really performing that well. And so when people just allocate their money to all 500 companies blindly, 75% of their investment capital is going to companies that just really aren't performing that well or mediocre. And I know we're covering like a ton of information on these segments, but one of the things, like Robert has a great video that's called 4 Myths Commonly Held About the Stock Market That You Still Believe. That video can really do a lot for educating people. And if they go to the wealthforlife.net, just fill out one of the forms online, we'll send them that video with Robert, because there's just a ton of information in there that can talk about and kind of reinforce some of the strategies that we're talking about.
So just expand, though, for a minute. Explain to people what the hell is a zombie company?
Yeah, so the zombie companies are when you look at the cost of servicing their debt exceeds their profitability. And there's a lot of companies, again, that go out right now and they're just borrowing more and more capital because money's cheap. It's easier for them to do. And they're not really looking at what is really fundamental about these companies. Are they really positive in cash flow? As their balance sheets look? And I think Robert can go into details because there's a very detailed process that he follows when we're trying to choose stocks and build these for clients. And Robert, maybe you can elaborate on some of the zombie companies that you're seeing out there.
Yeah, I mean, what happened back in March was during the most intense phase of the market sell-off, there was a disruption in the credit markets. And so the Federal Reserve had to come in and make sure that the lending system in the United States was functioning correctly. So in order to do that, they poured money into the banking system. And what they essentially did by buying corporate bonds for the first time, buying high-yield bonds, is they removed solvency risk for a lot of companies that otherwise would have faced bankruptcy. Now, if you're a bondholder, that's great because you're going to get your coupon payments, right? You're going to maintain your principal. But for an equity holder, there can be an initial rally in a lot of these stocks, but that doesn't necessarily mean they're great long-term investments. Because if we look at the cruise liners, we look at the airliners, for example, they have a lot of debt that they've piled on over the last few months. Like
and
American
operating
Airlines,
costs. Debt and operating costs. They need so much working capital.
Absolutely. And, but the real difference, I mean, airlines always have that high operating cost, so we know the delta in terms of the impact on their earnings is always going to be quite dramatic during good times and bad times. But the difference this time around is in order to survive, when the Federal Reserve essentially put a floor in the bond market, the airliners were able to go out there and raise a ton of debt, right? And, it made sense. They needed to survive. But then you have dollars of debt on their balance sheet, and with a very small market cap in terms of the size of the company, that will now have to service that debt. And we're talking these rates are not cheap. I mean, Carnival Cruise is paying over 10% in terms of their debt costs, and they're losing money every single month.
Well, hold on a second, but that really goes against the myth, because what you're seeing out on CNBC or a lot of these financial sites, they're talking about how the Fed's keeping interest rates at zero, so banks or corporations are borrowing at only a few percent. But you're saying Carnival, I mean, that's going to bankrupt them if they're paying 10%.
Well, Carnival and the airlines are sort of a certain segment. There's a lot of companies that are borrowing at record low costs, right? And that's part of the reason why you see the stock market where it is. But with these zombie companies, what you see is a high level of debt service costs. In other words, that coupon payment of 10% or north is obviously extremely high relative to where the federal funds rate is today. And so what happens is that unless your return on invested capital, in other words, the profitability, the margins of your business is higher than 10%, over time you're destroying equity value. Does that mean the stocks can't go up between now and 2 weeks from now or now and a month? Of course not. But over time, it does sort of erode that equity value. And we see that with a lot of these companies that are at the center of the COVID storm, because they had no choice. In order to survive, they had to raise this debt. And we saw the same thing after the tech bubble in 2000.
Well, you also saw it in 2008. They were over-leveraged. It's a recurring theme.
Absolutely. So whenever you get sort of these big collapses in certain industries, what tends to happen is they don't come right back, right? We saw with the banks. Yes, they got bailed out, but the actual stocks underperformed for the next 10 years. I mean, financials have been a structural underperformer since 2007. So, yes, bailed out, they survived, but they weren't really a valuable part of anyone's portfolio after the initial rally in 2009. Why is that? Because these companies have to go through balance sheet repair. The same way the U.S. government is going to have to go through balance sheet repair after this crisis. And so it's very hard to build equity value when you're going through the phase of paying down debt. And so for us, we want to focus on companies that can step on the gas today, that can take advantage of the fact that other companies are playing defense by going on offense. And the reality is that right now there's a lot of parts of the economy that are actually doing quite well, and the average U.S. consumer never really dipped into their savings through this shutdown. And so, you know, for us, taking a company-by-company approach is one great way, one facet of our strategy to really generate long-term value for our clients. I think any one of your listeners right now that runs their own business or is in the business world will tell you that 80% of their revenues come from 20% of their clients. There's no difference between that and the investment world. If we look at the index, about 80% of the returns on average throughout time will come from about 20% of the companies.
All right, let's
go ahead.
Yeah, no, let's just pause there for a minute because we're going to be going to break in a minute, and just a couple of quick comments. You talked about the Fed rate earlier, and I just want to clarify for anybody tuning in who doesn't quite understand that the Fed loans money to banks, the Federal Reserve. They loan money to banks at 0 or 1%, and then the banks, when they loan money out, they're going to add some interest on top of that. So that's what people get confused sometimes. They hear the Fed rate, and then they wonder why an interest rate or something is a few percent higher. But in regards to a couple other comments you made, we're going to come back in a couple of segments. We're going to talk about value investing and Buffett, but it's funny that you were talking about how the equity in a plane company or something, or Carnival Cruises, it's being destroyed and they're taking on more debt. And then ironically, Buffett, who's a big believer in return on equity, dumped all the airline stocks just a couple of months back. So it's kind of see that he's got those principles and you're showing exactly why he dumped those airline stocks. But, when we come back, we are going to delve further into tech. Robert's already described kind of how it compares to the dot-com bubble, but we're going to unpack it a little bit further, kind of how these tech companies and tech stocks in general, key word here, they have matured. So Robert was mentioning that Microsoft now, the PE is 30 times earnings. Even Facebook is at 30 times earnings, which is amazing considering it's a company that doesn't have inventory. Typically, when you're looking at inventory, you use different PE ratios. So we're going to talk about the current valuations of tech stocks. We're going to ask Robert in Denver if Tesla, Amazon, whoever, are they overvalued, and get more commentary on the rise of tech stocks and what types of companies people should be looking at. You're listening to the Business Roundtable. I am Matt Battaglia. You're on Independent Talk, 1100 KFNX. Independent Talk, 1100 KFNX. You're tuned in to the Business Roundtable. If you're catching us on streaming through the beauty of websites, the internet, and internet streaming at 1100kfnx.com, or if you're listening on your AM dial at 1100, we appreciate you tuning in. I am Matt Battaglia, host of the Business Roundtable, and we're talking about the economy, how the economy tanked, but how one sector, specifically tech and tech stocks, are thriving. The companies are thriving. But it's a big topic. I couldn't handle it on my own, so I had to call in help. And I called in Denver Noetz with wealthforlife.net and Robert Reaburn, the head of wealth management, executive VP at LifePro. So, Denver, give me an opinion on the street. You have clients calling you. Like you said, their management, their assets, they're doing well. But how do you have the conversation now when you're going stocks versus maybe they should be looking at other types of assets?
Well, I think the thing that we do is from the planning standpoint, is we're always using multiple different types of assets, and that's really the bulletproof financial plan, where you have different buckets that you're going to use for current cash flow needs. You're going to have buckets you're going to use for income. You're going to have buckets you use for tax-free money, and then you're going to have equity buckets where you're growing it. So no matter what's going on in the world, there's always a place that money can be pulled from. And
I noticed you didn't mention a bond bucket. I didn't hear the bond bucket. What about a CD bucket? Is there a CD bucket?
You know, so typically, like, again, usually people are going into fixed income or bonds and things like that for, you know, typically to try and generate income. And we find that obviously there's better rates and better ways to do that using annuity strategies and life strategies. We'll typically use those more for income plays. And what that allows, and then of course we set up money aside for emergencies, and then we go and we take what Robert does and we get growth on the portfolios. Because what hammers most people when they get into retirement planning is everyone just says, hey, it's time to go into the safe portfolio and you know, all into bonds, and the returns are, you know, pretty poor and they don't get a lot of growth on their portfolio. When you set it up right, like we've done for clients right now, it's like, you know, they're sitting there looking at a 50% gain in their equity portfolio and they're retired. And that's because we have income set up from different sources so that there are always places they can pull money from. They don't have to just sit in these mediocre bond portfolios, or back to the topic that we're discussing where they you know, just buy the ETFs or they buy the market and they get, you know, 20% of their money is going to zombie companies, another 50% is going to mediocre companies. And like what Robert does too is we also, you know, specialize and go after certain sectors. Like, you know, you're not going to go out right now and say, I'm going to have mutual funds that are investing in the malls, because why am I going to invest in malls right now? I'm going to invest in e-commerce. And I think a lot of people think that that kind of analysis and planning is going on in their portfolios, but it's really not. And that's where I would say I would encourage people to get some of the video series that we have. We have a lot of them, like the one I keep mentioning where Robert has this great one on 4 myths commonly held about the stock market that you still believe. That will explode most of what people believe about the stock market and really also justify why most people look at their portfolios and go, wow, I really feel like my portfolio sucks. I really feel like it's not doing any good. That's why there's so much distrust toward the big investment world and the investment advisors, and people don't want to pay for it because usually the results they get are mediocre. And Robert really lays out why it's mediocre and why it doesn't work, and why there are alternatives out there. And people can get those at wealthforlife.net. Just go there, fill out one of the forms. We'll make sure you get the videos. And Robert, I mean, it's just amazing in what he does. That's why, maybe, Robert, you can expand a little bit on it.
Yeah, Robert, expand on actually a couple of points, and we'll get back into tech in just a minute and how the stocks are killing it. But savers are getting punished. The bond market's been pretty lousy for not even the last 5 years, probably for 10. And then on top of it, the old 60-40 portfolio or 50% equities, 40 bonds, 10% cash. I mean, that portfolio is a train wreck.
Yeah, I mean, a few things. So you're absolutely right. There's a tax on savers right now. The way we have to look at asset allocation is to go back to the 1950s. Right in 1950, we were just exiting that, the Second World War, which ended in 1945. And in order to buy victory, we had to raise a lot of debt as a country. And, debt to GDP was around 100% at that point, probably a little bit north of that, around 100, 120%, depending on how you measure it. In order to pay down that debt, there was a few things the U.S. government had to do. Yes, they raised taxes, and there was other uncomfortable things that had to take place. But most importantly was what they did with interest rates. The U.S. government would pin interest rates below the rate of inflation. In other words, they would punish savers and inflate away the real value of U.S. government debt. It's what we call financial repression. That is one of the best ways that developed market economies reduce their long-term debt load.
They've been doing it since the times of Greece and the first time they issued paper fiat money. I mean, it's gone on 1,000, 2,000 years.
Absolutely. Even in the Roman Empire, what they would do is they would reduce the gold content within the coin itself. And so, there's just different ways that the government can work to reduce that debt load over time. So right now, what you're going to see is that interest rates are going to be pinned. And one of the things that they're talking about, the Federal Reserve is talking about, and we'll eventually see it whether it's in shadow form or whether it's in direct form, is a concept we call yield curve control. In other words, right now, when you were just mentioning the federal funds rate, the U.S. government, the Federal Reserve, sets the short-term interest rate.
Right.
But what they don't do is they don't control the 10-year rate, which is what controls mortgage rates, lending rates, a lot of stuff like that. Under yield curve control, what the U.S. Federal Reserve would do is actually control the 10-year rate, pin it so it can't go above a certain level. How would they do that? They would do that by going out into the open market and buying more and more bonds of specific maturities to control that interest rate, similar to what Japan is doing right now, so that they can inflate away that debt. So that is a punishment on savers. That, as you mentioned, CDs, your typical savings accounts, even bond accounts, right? So if we look at Microsoft,
Grandma's getting killed
1%
right now, Robert. Grandma can't buy. Remember when you were a kid and they bought you a bond? They bought you a CD. They can't do that anymore.
That was a fantastic gift back then.
Yeah,
they were paying 15%, right?
Right.
And, you mentioned the 60-40 portfolio. One of the things we do here at Life Pro, one of the things that Denver does, is that we do not discriminate based on age, right? So the classic rule has been, as you get older, you reduce your equity exposure, you reduce your bond exposure. The reality is that everyone's different. Everyone has a unique set of needs in their life, in their financial life, and we really need to understand how we set asset allocations based on when a person needs their money, right? So if you have someone that has $100,000 in savings and needs that money year in, year out, and they're going to be using that money over the next 5 years, they should not take a lot of stock market exposure. Their main objective has got to be preservation of that wealth.
Right.
But if you have someone else who's, say, 70 years old, and they have $1 million, and they only plan on using $200,000 of that over the next 5 years, why is it $800,000 being put into bonds? It should not be. That $800,000 has time on its side. It can take the volatility risk of the stock market to increase its potential growth rate. Because we know even in 2008, had you invested right at the peak, you were still in the money by the time 2012 came along. So time is really the number one variable that should determine whether you're in stocks versus bonds, because volatility is not a bad thing, right? If you have a diversified portfolio in stocks, you'll make money over the long run, but you need to have time on your side. Versus if you need the money in the short term, and you need it in March, you could lock in a lot.
But if the government, and we got about a minute and a half left, but if the government is pinning interest rates and they're gonna fight to control inflation like they've been doing forever, and they're gonna punish savers and they're gonna punish bonds, you could make the case that you're better off buying the Apple stock than any type of corporate bond or this corporate welfare where they do continue quantitative easing for the last 10 years and just buy up these bonds. Hold the thought there, Robert. We're going to go to break in just a moment. And when we come back, we're going to further this discussion as far as tech stocks. Hopefully Robert in Denver can give you a little advice or further advice on kind of what you should be looking for, maybe a couple of the companies that are on the rise. But I also want to talk briefly about value investing and if it seems like value trap is more of a problem today than it's been in a long time. Looking at stocks that are down and hoping they're going to rebound, but nowadays less of them are actually rebounding. And tech stocks and your Twitters, your Amazon, your Netflix, they're all continuing to explode. You're listening to the Business Roundtable. I am Matt Battaglia. We are on 1100 KFNX, 1100KFNX.com. Tune in. We'll be right back with Robert Reaburn and Denver Noes. Independent Talk, 1100 KFNX. You're listening to the Business Roundtable. I am Matt Battaglia. We're talking the economy, COVID-19 crisis, and why are tech and tech stocks thriving. Big topic, big subject, and needed a lot of help today. So called in a couple of experts on it. Denver Notes with wealthforlife.net. And if you want to see some great videos and content on how to do financial planning and kind of really, it's a shaky ocean out there. How can you work through it better? Go to wealthforlife.net. Check out some of his videos that he's got posted. We've also got Robert Reaburn. He's the head of wealth management, executive VP over at Life Pro Investments out of California. And we're talking tech stocks, but I'd like to backtrack just for a minute. For the longest time, we heard about Buffett. We heard about value investing. I personally am a believer in this, but I've had a lot more success the last 5 years, quite frankly, not following those trends because certain stocks I've invested in, they've been value traps where you look at their 52-week low, they're a good company, they're, can you get 10, 20% off them because the stock's going to rebound. But a lot of these stocks, and you brought it up, financials, perfect example, they're not rebounding. And yet I buy Netflix, I buy Apple, even Buffett sold his airlines and has been putting money into Apple the last 3-4 years. So Robert, the world's kind of turned upside down. What's the state of value investing?
I would say value investing is thriving, and that may sound counterintuitive. But, one of the questions we always ask clients, we always ask investors, advisors, is tell me what value is, right? And I think the problem right now when we see charts like growth versus value, when we see that value is no longer a thing, is that at the end of the day, does value mean buying companies that are 52-week lows? Or does value mean you're buying companies that are set at bargain prices relative to their earnings power going forward?
Well, the old, hold on a second though, but the old, okay, so the old Ben Graham, cigar butt, 52-week low. Okay, so and even him late in his career and Buffett, they kind of moved away from that. So maybe the traditional value investing is off the shelf. Then is a stock like Apple or Facebook or Microsoft trading at 30 times PE? Could you argue that these are modern day value picks?
You could in a way. Now, with Apple, what you always have to say, there's always two things you always have to look at. This is how we look at stocks. They're businesses. And we have to say, A, does the business make sense? Do we like the actual business? And I think that's a question that a lot of people don't actually ask and answer when they're looking at stocks. They will look at the metrics. They'll say it's a low PE, a high PE, it's in an attractive sector. Do they like the business? Do they like the people running the business? Do the people that are running the business have a good track record of creating shareholder value? That's the first thing. Second is are earnings actually growing or are they shrinking? And because I bring that up because if you look at the Apples, the Microsofts, the Amazons of the world, yeah, their PE is a little bit high, but they're also growing their revenues 20%. So, and I'll sort of add a caveat that we actually don't own any of the FANGs right now in our portfolios, but we like the characteristics of those types of businesses. We like the characteristics of businesses that have positive earnings, low levels of debt on the balance sheet, and are growing their earnings at a multiple of what the overall market is.
But you sound more like Peter Lynch, though, than you do a value investor, because that's pretty much his philosophy.
Well, I think the problem is right now is that, and you're always going to have this problem, is that people want to characterize certain styles of investing. We don't put ourselves into a bucket. We just basically say, does this business make sense? And is that at a price relative to its future growth rate that makes sense? So if you look at, a lot of people bring up the department stores as a value play. We would say that's actually a value destruction play. Because you have a company that might, like Macy's, maybe it's trading at 5 times earnings, but if its earnings shrink 50% year over year, then it's no longer trading at 5 times, it's trading at 10 times earnings. And if its stock catches back up to 5 times earnings, then it's going to go down 50%.
Right.
And that's really the problem right now is that, everyone defines everything as technology. Amazon is a retail stock, not a technology stock. It uses technology, but it's really a consumer play, right? If we think of Facebook uses technology, but it's an advertising company, right? And so when you're looking at Facebook, you have to say, what are you willing to pay for a monopoly, right? When we think of advertising budgets around the world, all those advertising dollars that are going into magazines, newspapers, billboards, they're all going away because they have low conversion rates relative to Facebook. And so Facebook has a 1.4 billion person audience that they can target with a high level of specificity that you can't do with these other channels. And yes, Disney put their shelved their advertising dollars, but guess what? Every small and medium sized business, and Denver will tell you this, are using Facebook to grow to grow their overall business. And so, the difference is the Netflixes of the world, the Facebooks, the Microsofts, the Amazons, they're monopolies, they're platforms. And so you're always going to pay a higher multiple for a business that doesn't have competition versus a business that has 100 competitors and is completely price sensitive.
Well, let's get in our final few minutes. Let me just bring Denver back on for a minute. Let's just get some final thoughts, because Denver, with all the stuff Robert's talking about, your approach typically is diversified, but not diversified in the, we're going to go 60% bonds, we're going to go 40%, or 60% equity, 40% bonds, or whatever the case may be. But when it comes to technology, you're looking for financial products that are hopefully taking advantage of the trends. And you mentioned annuities or life insurance. These are products that are basically hybrids. So what's the quick, 2 or 3 quick tips in a minute that you would give to a client?
Yeah, I think Robert kind of hit on it. It's like that a portfolio and the way you design wealth for your retirement is not discriminatory. It's not one size fits all. So if most clients get a one-size-fits-all. They come into an advisor and they say, oh, you're 60 years old, so you're in a 60-40, here you go. And that's just not the best way to optimize and design wealth. It's really, designed on a person's income, how much assets they have, what their needs are going to be. And then you look at everything and the best that the investment world and the insurance world and the financial world has to offer, and you put those pieces together. So the practicality for an individual investor is to sit down first and start looking at what they have. And if they're holding a bunch of mutual funds and ETFs and portfolios and they're down or they're not happy with everything, one thing they can think about is, hey, do I want to be investing in all sections of the economy and just buying the index and hoping and praying that everything in there is doing good? Or do I want to be a little more specialized and focused on certain areas of the economy like e-commerce and things like that that are going to do well? And then do I want to have different buckets in different places so I can protect money from taxes, so I can protect it from market losses and have income coming in? And when you put all of those pieces together, which most people don't have, most people get this stock off the shelf, here you go, here's your mutual funds, here's your investment. They don't get that variance, and that's why you see kind of a high level of dissatisfaction, worry, and stress. And so when, most people are worried and stressed about their money, but when you put these, all these pieces in the right place, and part of that process is getting educated. That's why that's why we put out so much educational content. Robert puts out incredible market updates every week that people should subscribe to. I put out videos. You have these shows like you do and podcasts. And just to kind of contrast the difference of that, you don't have to be stuck in just buying off the shelf, buying mutual funds, hoping the market's going to do well. You can really put yourself in a better position. And there's resources to do that, and that's what we're trying to provide.
All right, Robert, you got the final word. You got about 30 seconds. What are maybe the 2 or 3 tenets that people should be thinking about in the back of their mind?
I would say the big thing is whether it's our investment strategy or a mutual fund or single stocks, if you're going to go into the stock market, give yourself time, right? If your plan is to make a quick buck over the next month, you could get burned, right? There is a reason why they call it a bull market and a bear market, because both animals are hard to ride on top of, right? And they'll both knock you off the saddle. And the reality is the market itself is going to be volatile, right? From peak to trough in 2007 to 2009, the stock market went down 50%, right?
We're gonna have to close on that. The market is volatile. And I love it. Think long term, think diversified, and go out and get some help, or at least get educated. You can go to wealthforlife.net. You can learn about Denver Noah's strategies. You can also learn about Robert Reaburn, head of wealth management with Life Pro Strategies. You've been listening to the Business Roundtable on 1100 KFNX.